But for more on the Fed, let's go to D.C. and let's talk to Brian Cheung, who was in the meeting, who asked Jay Powell a question he did not want to answer, a question, Brian, that you and I had sort of discussed previously, which was, are you explicitly pushing back against fiscal policy? And he was like, well, that's not part of our mandate. What was your read on that room? Because it seemed like the group of you reporters were a little bit frustrated by Powell's just denial of everything, right? He's like, well, it wasn't that big of a change. And I think they made a huge change today.
Well, I think the big question and the big takeaway was the Fed revised down its estimates across the board on unemployment, on GDP, on its projected path of rate hikes. But Powell still said that the economy is in a good place, and he painted a similarly rosy picture to the end of January, where basically he was saying that, look, the economy is facing issues. He later described it as cross currents, and then said that the Fed just needs to take a wait-and-see approach while it figures things out. But if we've seen anything from the SEP, not just the dot plots, but the estimates on unemployment and GDP, as I just mentioned, it's really a gloomier picture than we saw. And I understand that it's only a few basis points of downward revisions, particularly on GDP and also on inflation. But it does bring up this point about what does the Fed see in terms of the future of the U.S. economy? And my question was trying to get at the point, look, if the Federal Reserve is on wait and see right now, and fiscal policy is basically done in terms of economic stimulus because of the fact that the tax reform is waning off and that the odds of an infrastructure bill are fairly low, what is the Fed waiting for? Is it effectively waiting for the economy to slowly turn into a slowdown and then the Fed will be reactionary? And Powell didn't really directly answer the question, but I think it was interesting that he said that the Fed won't overreact to fiscal policy, because in a way that does acknowledge that the Fed is taking on a reactionary role right now. And this kind of speaks to this larger shift about what should the balance be of monetary policy and fiscal policy in steering the economy. And right. It seems like in this post recovery period that it seems like monetary policy would prefer to take a step back and react to fiscal policy.
Yeah, it's the post-recovery but pre-MMT period, so the Fed hasn't quite dealt with that yet.
And that's your terminology.
Yeah, well, hey, I think we all agree it's here. So let's just talk about the idea that the Fed's next move must be a reduction in interest rates. We saw a number of analysts on the street today saying that, oh, we're definitely going to get 2 or 3 rate cuts next year because the Fed is no longer increasing interest rates. I did get the sense that Powell's pretty clear and firm, like, okay, we're just going to do nothing. And I know they've been transparent about that, and we're so used to parsing what does Yellen really mean? What did Bernanke really mean? Ultimately, he's kind of plain spoken. We're going to be patient, which means we're not raising interest rates. I don't know what else to tell you.
I mean, to the point about a rate cut, I don't know if the downward revision on the dot plot necessarily points to that explicitly. We did see that the revision for the dot plots were revised down, particularly for 2020 and 2021. We had previously seen in a December meeting that they were projecting up to 3 rate hikes for the median dot in 2021. But now we've seen that the expectation is for no rate hikes in 2019, only 1 by the end of 2021. But I do want to note that the long-term, interest rate is actually still the same. So basically, it went from kind of a bell to kind of just a more flat linear line. And I don't think that if you look at the long run interest rate, it actually signals any sort of rate cut. But I think you do bring up an interesting point about just the general read on the Fed. I mean, look, I think when you talk about the Fed's process right now, for example, on its balance sheet normalization process, in tandem with the fact that they are trying to figure out where the natural rate of interest is, this is all unprecedented territory. The no central bank around the world has ever tried to undo the unconventional types of policies that it engaged with after the financial crisis. And I think that you see just, not just markets, but also the central bank and Powell and the other policymakers themselves also trying to grapple with this. So I think everyone's kind of going along with that analogy that Powell used about walking around in a dark room and trying not to stub your toe. That process is not over yet. And I think that even though we have more granularity in terms of where the balance sheet normalization process is going, because we got a little bit more information on timing, we still need to have these questions answered on composition and the long-term, short-term nature of the assets that it holds. So I think all of those will remain questions as we get to that May 1 meeting and then after.
All right, Brian Cheung, live in D.C. Thanks so much.